Thank you very much. 12 minutes isn't a lot of time to talk about the potential for a wealth tax in Ireland, but this afternoon you're going to hear about the potential for a global wealth tax, and one of the dangers is that if we focus on the introduction of a global wealth tax, it actually removes the responsibility of individual nation states to consider the issue of introducing a wealth tax itself. So what I'm going to do is, first of all, I'm going to look at the fiscal context in Ireland, talk about some of the definitions and concepts, because it's important to understand what we actually mean by a net wealth tax, and there's a lot of confusion in this area. To discuss briefly the wealth tax debate, both pro and against, of course, to look at some estimates of household wealth in Ireland, to explore the main policy considerations, and finally to look at what would be the implications in terms of effective rates and indeed potential yields. And finally I will conclude. First off, I would note that the Irish Fiscal Council has just expressed concern that primary public spending in Ireland will fall to historically low levels over the next few years, well below Western European norms. This will put pressure on social payments, it will put pressure on public services, and it will put pressure on public investment, even above and beyond the levels we have already reached. Under this analysis, we have not at all reached the end of austerity, and given nominal amounts staying the same in the environment of inflation, we can expect deteriorating public services over the next few years. The alternative is to widen the tax base to increase revenues, and we've already seen a number of policy innovations in terms of USC, property tax and water charges. Yet whenever wealth taxes are mentioned, they're automatically dismissed as though they're implausible, impossible, and so forth. One of the problems perhaps is that the advocates of wealth tax overclaim the amount of revenue that could actually be generated. However, in the absence of taxation on wealth, wealth dynamics dictate that wealth inequalities will deepen and widen over time, thereby increasing inequality. So a wealth tax ultimately should be the most popular of all taxes, because depending on where you set the threshold, you could potentially be talking about a tax hitting only 1 to 2% of households. So this would actually be a fiscal consolidation measure which would not reduce incomes of the vast majority of society. However, there is a caveat. Not all wealth taxes are the same. It's crucial that a wealth tax, if it was to be introduced in Ireland, be well designed. And I'm going to talk about what a well-designed wealth tax would actually look like. But there are bad wealth taxes, and most of the wealth taxes that currently exist in Europe are very, very poorly designed and riddled with exemptions and reliefs. So why is a wealth tax not being considered? Well, capital flight is the classic argument against, but also potentially the administrative burden. Both of these difficulties can be surmounted. So is a wealth tax possible, and what would it look like? Well, first of all, any tax has three objectives: equity, efficiency, and simplicity. And we have a number of goals and rationales for introducing a wealth tax. First of all, it would increase transparency. This would allow people to see who the owners of wealth are, not the individual households, of course, but in terms of its general distribution, in terms of how much wealth there is in a country compared to the amount of income there is in a country, the amount of income that is generated from wealth, and so on. And only by having that information can we as a democracy make a genuinely well-informed decision about how best to tax and how much to tax. Second, of course, it would raise potentially a meaningful amount of money for the Exchequer. This would allow us to reduce taxes in other areas or to improve public services. So it should be seen as a political choice. There are, of course, disadvantages to wealth tax, just as there are advantages. But all taxes and all public services and social payments should be put through the mill of a cost-benefit analysis. It would, of course, improve horizontal equity. It would improve vertical equity, but we must design it in such a way as to minimize economic distortions, minimize the risk of capital flight, and minimize administrative and compliance costs. So, design is everything. One of the common misconceptions about wealth is is simply what it is. Wealth is a stock, income is a flow. So increasing income tax on those earning over 100,000 is not a wealth tax. It is an income tax. A net wealth tax is a tax on gross assets minus liabilities. What are assets? Well, there's real assets and there's financial assets. Some assets are transferable, some of them are mobile, and there are lots of different types, from land to real estate, to business equity, to vehicles, to cash, current accounts, pension fund equity, even human capital. In the euro area, the household main residence makes up over half of all wealth. However, for the top decile of the population, this is not the case. And as you move further and further up the wealth chain, the greater and greater the proportion of a household's wealth that is made up of financial assets. The Household Finance and Consumption Survey last year of the European Central Bank looked at this and found that main residence was over half of all wealth. So, what type of wealth taxes do we have in Ireland? So far, we only have one, really, which is capital acquisitions tax, riddled as it is with exemptions and reliefs. Pension levy and local property tax, and indeed capital gains tax are forms of pseudo-wealth taxes. The net wealth taxes already exist in a number of countries. So what I'm going to do now is simply look at what the potential implications are within Ireland, and to perhaps identify how much could be raised. In terms of distributional data, it's very limited in Ireland and will be until later this year. The Central Statistics Office will be contributing to the Euro Area Household Finance and Consumption Survey for the first time, and this will give us wealth distribution data for the very first time. But the central bank estimates that there's about 504 billion of net assets owned by Irish households. That's about 110,000 per capita, and of these net financial assets are about 159 billion. In the euro area, real assets make up 85% of total assets, so this is probably an overestimation because financial assets are easier to hide. Households in the 10th percentile own 1,200 euros in net wealth, so that might be their car, for example, and that would be it. On the other hand, households in the 90th percentile own 506,000 in net wealth. So households in the 90th percentile, which is far from being the very, very top, have controlled 422 times the wealth of the 10th percentile. So you can see that wealth is much more unequally distributed than income. In terms of how you would do it, you have to consider what your appropriate tax base is, and all assets should be taxed. It's tax on net assets, so you deduct off liabilities. There should be no exemptions or reliefs whatsoever, because if you introduce exemptions and reliefs, you undermine horizontal equity, you distort investment decisions, and you create scope for tax avoidance. It becomes very easy for richer households simply to avoid the tax. We must remember that wealth itself is unlikely to be the source of actual payment. It will be a payment out of income, and therefore has to be considered in conjunction with the income tax system. What about the potential for threshold exemptions and reliefs? One of the things that you will find when a new tax is introduced, if it ever were to be introduced, that you would immediately have lobbyists for every type of asset under the sun to be exempted, from owner-occupied housing to pension rights to business assets and so forth. As soon as you do that, you create shelters. So no assets must be exempted. In terms of who would be liable, you'd be talking about individual households but not companies. Then you have to decide, is it based on residency, citizenship, or location? All questions which create their own policy issues. In terms of historical yields that have been generated from net wealth taxes, and bear in mind that these are taxes that have been riddled with exemptions and reliefs. On average, they tend to generate about 0.4% of GDP, although it actually varies quite widely. 0.4% of GDP is currently about 650 million, which is more than water charges are currently scheduled to generate. But it would be incorrect to say that a wealth tax would generate a particular amount of money, because it depends upon a number of factors. It depends upon the defined base, the tax unit, the threshold, the administrative costs, and so on. All of these are individual policy issues that would have to be resolved. So it's misleading to say that there is a particular amount that you would yield without doing that analysis. In terms of wealth shares, we can see that the amount controlled by the top 1% varies widely from country to country. The latest we have for Ireland is Nolan from 1987, which says that the top 1% of 10.4%. But the wealth share has increased in all European countries over the last 20, 30 years, so we're anticipating that figure will have increased. More recent work on tax returns show that may be now as high as 12 or even 13%. So sample liability, and I'm almost finished. The top 1% of households, there are just 16,807. You're unlikely to be in that 1%. To obtain a yield of 150 million from the top 1% would meet an average tax liability of just 8,925. To get it from the top 5% would mean an average tax liability of 1,785. Would this cause a massive flight of capital? I would argue perhaps not. Larger yields, 300 million, 600 million, you would have to increase the figures proportionally. But given that there is a return on capital in the long term of perhaps 5%, it suddenly becomes clear that there's also a maximum amount on the actual wealth tax rate itself, which is probably no higher than 1%. And just to show how light the actual burden would be, at a 0.5% rate and a 1 million threshold, once you net off all the liabilities, exempt assets and release and taxable assets, and have an assessed wealth of 1.5 million, you have a taxable wealth of just 500,000, and at 0.5% a tax liability of 2,500, which is an effective tax rate of 0.17%. Hardly onerous. So I'm practically finished. But just to say, in conclusion, that the core objectives, again, remember, are equity, efficiency, and simplicity. Is a wealth tax feasible? Absolutely it is feasible. There were questions as to whether a local property tax and water charges were feasible. Historically, there were questions over whether VAT and income tax were feasible. Where the will is there, it is possible to do this. We had a wealth tax in the past between 1975 and 1978, and it was a debacle because it was full of exemptions and reliefs. It was badly designed. The tax avoidance lobbyists got in there early, and it only generated a tiny amount of income. But a properly designed wealth tax could certainly raise hundreds of millions while still retaining a high threshold, perhaps $1 million, and even a low rate. So, again, there are issues. High administrative costs is a potential problem. Mobility of capital is an issue too. All of these set realistic maxims on the rate, but nevertheless, it is certainly possible. So to absolutely conclude, a suggested structure would be 0 or very few exemptions and reliefs, perhaps for human capital, a relatively high tax-free allowance or threshold, and a flat marginal rate that is set at a low level, and that would generate certainly 150 million a year, and perhaps even 3 times as much. Okay, I'll leave it at that.